It's hard to breathe, but that's alright. Hush.
Hey everyone, so I quickly wanted to cover something, and it's about whether you should target the equilibrium or the open when it comes to taking a trade. So you may be wondering, well, I always see you mark up a supply and demand zone. You're either trading from the open or you're trading from the middle. Which one are you doing? And the truth is, it's completely up to you. I can't say to you to trade the open. I can't say for you to trade the equilibrium, and I can't tell myself what to trade because I trade both of them. Right, but when you must understand the differences, okay? So when it comes to taking a risk entry, you're better off going with the open because there's a higher probability of, even if price comes back to equilibrium, it's still in the trade, right? But if you're confirmation traded, then it doesn't really matter as much. However, when you're on a 1 minute time frame, the order blocks and the size of the order blocks on a 1 minute time frame are tiny compared to the high time frames, right? So that's the difference. If you're looking for a trade and you want to focus on higher rewards, then the equilibrium obviously will be better because it's going to give you higher return. Because if we look at this example here, right, because if we just target this demand zone, let's just round it up to 7%, right? But if we move it, that's taking the trade off the open. But if we move it to the equilibrium, you can see that it's 15%, rounded up to 15%. Okay, so there's a much difference in terms of risk to reward, and when you focus on the equilibrium, there is obviously that bigger reward on equilibrium, right? But if another thing to notice as well, if you find a high time frame range, point of interest or whatever, and it's quite a big range, then it's obviously going to be tricky to trade, because if you're trading the open of that and it's a big range, so for example, if we just drag it out to let's say this there, say for example this was a whole range, right? I know obviously it's not a range, but it's just say for example it was, and we're looking to sell on the open, right, and your stops are above there, that's going to be much trickier. So this is the reason why it's when you refine order blocks and refine it, and also if you just trade confirmation entries in general, all we can look at is for price to tap into this region wherever it taps into. We don't care, because what we'll do is we'll jump down to 1 minute time frame and look for that confirmation entry. We can go to the 1 minute time frame now, and I can guarantee we'll almost see something. Right, straight away you can see something. Right, what can you see? Right, price tapped into the order block, right, and this is the different type of entry which we'll jump into in Wyckoff. But for example, you can see here that this is a Wyckoff distribution phase, and also it's a liquidity sweep. So as you can see, you've got equal highs, price liquidated to the upside and took that sweep to the upside. Also in terms of entry, price broken structure to the downside, which is obviously confirming that bearish move. And this is the order block that created this bearish move. So what we can do is drag this out to the right, focus on that bit of price action, because you got to remember as well, when I say order blocks are tiny on 1 minute, this is an example. So it doesn't really matter if you're trading the open or the equilibrium when it comes to taking trade on 1 minute time frame. In terms of stops, you would have them just a bit above this wick here. Let's go with just there. And now you'll still be in a trade, but it's up to you if you want to, again, wait for any bearish confirmation. I may as well cover this. I won't do a separate video for this. But if you want to increase your high probability trade setups, what you can do is when price, even though we've tapped into a high time frame point of interest and we're looking for confirmation entry, so a broken structure, took out these lows, Wyckoff phase, right? There's two things right there that tells us we're in bearish market, all right? Price then sees momentum, so as you can see in terms of momentum, price is very bearish, right? This bullish move is nowhere near as powerful as this bearish move. So again, another confluence. In terms of range highs to the range lows, we're selling at a premium, right, way into the premium, so we're getting selling at an expensive price. That's the way we see it, right? So all the confluences add up. So this is a fantastic opportunity. But to increase that trade, what we can do is if we target this order block here, right, and we look to take a sell there, right, so for example there, rather than taking a sell there, what you can do is wait for the bearish candles. So for example, in this case, we didn't close below with the bearish candle, right, but we closed below here, right? This is obviously a lot more riskier, and it will decrease the risk to reward, so it's not something favorable. But often what I'm trying to say, if you see a bearish candle that's bigger than it's closed below the previous bullish candle and it's within the point of interest, that would be a nice confirmation. So what we can do in this case, right, price created a bearish candle, so this tells us that there's some bearish signs, some bearish movement. You can either set a retracement, but on a 1 minute time frame, because usually what you can do is set equilibrium of the body and set a sell limit, so price will tap back into that. But in this case, there's literally no point doing that because it's tiny. So what you can do is wait for any signs of bearish confirmation. And that's what I mean. Simply a bearish candle. We wick reject to the upside. It looks like a liquidity sweep tapping into the another order block or liquidity. Stops are going to be matching this wick now, and you're going to just target the higher time frame lows, because remember, we don't care about the lower time frame. We only look for the lower time frame for our entry. So if we go back to the 4 hour, which is where the point of interest was, we can look to target all the way. I have to drag it now, don't I? We can look to target all the way down to the H4 lows. If we just let price do something, right? H4 lows, as you can see, that's 134% trade just from a small confirmation entry. So what would have been originally, and as you can see right now, if we target all this low, obviously, it depends on obviously where we enter, but that's a 208% trade, okay? But if you were looking to do that, just trading risk entries, right, based off this order block alone, and your stops are above there, so if you just put this back to this order block, you traded there, you caught the open, right, your stops are above there, and also obviously not the perfectly open trade, but you get the idea, and you'll target in the same place, you're getting only 18%. So that's the main difference in terms of open and equilibrium, and also between the risk entry and confirmation entry. That's the main difference, okay? So it's up to you. Obviously I prefer confirmation entry, because not only does it increase your strike rate, and when I say strike rate, I mean like it's confirming like that move. So when you're looking for a confirmation entry on a small time frame in an overall bearish market, and price being bearish, it's going to be a much higher probability setup than it is looking for a trade up here, right, for a risk entry, because we know if we don't get any confirmation, if price doesn't break any structures and continues bullish, right, then we know that that's not the right point of interest to target. But if we start reacting from there and we see the structure breaks, that's going to be the right point of interest to target, right? So you get the idea. So why the hell would you want 18% when you can get 208%, baby? So it's up to you guys. It's completely up to you on what you want to do. Personally, I prefer confirmation entries, so high time frame point of interest. Once price taps into that region, that's when I go down to the 1 minute and look for my confluences, look for my sort of confirmation entries. So in order to learn all this, you need to obviously go through the whole course. You need to understand order blocks, you need to understand market structure, understand supply and demand, and you need to understand the confluences that I look for when it comes to taking a trade on low time frames. And also you need to understand that each of us are different. So you may not have taken this trade, but I may have taken this trade, right? In my textbook, this would have been a nice valid trade setup, but to you it might not be, because everyone trades differently. Everyone has different emotions and psychology, how they handle things. Backtest that's the only place you're going to learn is backtesting. Once you understand these methods, it's all down to you to put into put the work in, because I can sit here and teach you all the different types of methods, but if you don't apply it and practice using it, you ain't going to learn. So make sure you put in all the the effort and everything you've learned into backtesting. Right, so just go and draw order blocks. Go and draw every single order blocks. I don't care if you draw all this order block. I don't care if you draw this order block. I don't care if you draw this order block. It doesn't matter, because every single time you can use it as a learning curve. So for example, if you draw an order block here, you look to sell, even though I wouldn't, you're probably thinking, well, why wouldn't you, Luke? You're being so smug, why wouldn't you do that? And the truth is, I wouldn't do that because it's not within our premium zone, okay? So this is why we use confluences, because it helps invalidate point of interests and stuff like that. But if you forgot to use that confluence, right, and you looking to sell from there, and you had a point of interest then, looking to sell from there, and you had a point of interest, you're looking to sell from there, you can start to see which one's price starts to respect more, especially if you're backtesting only one pair. So for example, you're a yen, you can start to see that if you have 3 points of interest, which one does it respect more? It usually likes to respect the middle one, so the equilibrium price, right? If you go on a different pair, you may find that it respects the most recent order block prior to the break structure, right? So it's all down to you to put in the work, okay? No one can say anything or do anything for you. I can't sit there and place trades for you. You need to put in the work, guys, okay? It will be hard, don't get me wrong. You're gonna have nights of frustration. Trust me, I've been there and I feel you. But trust me, it's so worth it, guys. If you can just dedicate the next few months to learning. So I've gone very off topic there, but I just wanted to, it's halfway through the course, I'd say. I think it is. So I wanted to just give you that realization, just keep focused, right? So yeah, thank you for watching, guys, and enjoy the rest of this section.